Farms.com Market School with expert commodity analyst Moe Agostino is an online educational video series designed to help you, the farmer, improve your knowledge of grain marketing. Farms.com Market School is brought to you by DeKalb Brand Seeds. DeKalb, growing confidence. So today is part 2 of our continuation with the recap and summary of all our educational videos, and we're again trying to put it all together for you. Our topics today include crude oil and ethanol futures prices, USDA corn, soybean, wheat, ending stocks and balance sheets. Keep an eye on weather, US drought monitor map. Let's talk about fear and greed, why it's important. Focus on fixed forward contracts, but also use tools such as futures and options. Be aware of the global political landscape. Use fundamental and technical analysis. So our first topic today is crude oil and ethanol future prices. Here's an example of crude oil and ethanol on the same chart. So red is crude oil. The black lines are ethanol. Don't overlook high crude oil prices. They usually equate to higher ethanol prices and vice versa. Higher ethanol prices equals more profits, equals more corn usage. Higher ethanol futures and lower corn prices equals higher margins, which equates to more corn usage. And that's important for the U.S. corn balance sheet because that's how you're going to project ethanol usage forward. The more demand, more ethanol usage. Again, it's a big part of that corn balance sheet, means lower ending stocks, higher prices. The cure for high prices is usually high prices. Watch for U.S. corn prices for direction, as U.S. corn is still king corn, and everything else follows. A rising tide lifts all boats. Our second topic today is about USDA balance sheets, corn, beans, wheat. Here's an example of the U.S. corn balance sheet. There's a lot of numbers on here, but what I want you to focus on is what I've highlighted, which is the ending stocks number on corn. The smaller that number, the better. That means higher prices. That means the market has to ration demand with that higher price. Understanding the past with the USDA, knowing what they do or what they've done, can give you a glimpse of what the future will bring. Our third topic is about weather. Keep an eye on that U.S. drought monitor map. Understanding a weather rally versus demand market or supply shortage is also critical. Weather rallies can come and go, but they can evaporate faster than they were created. We usually take the stairs up and the elevator down. Weather can cause a supply shortage. So prices usually are driven by this supply shortage. Any production problems due to weather, locally or internationally, can cause prices to rise. A good example is the 2010 Australian floods. This turned 40% of the Australian wheat into feed wheat and caused wheat prices to rally. Our fourth topic is about fear and greed. And here's an example of the 2011 November soybean weekly futures chart where fear of dry weather caused beans to rise in 2011 to about that $14 a bushel level. That's when you gotta sell, sell, sell. Understanding market psychology is crucial. Fear and greed can take markets to extremes. When the futures price is well above the 200-day moving average at seasonal peaks, funds are long and news is factored in, you need to sell that. The very opposite is also true. Our fifth topic today is about focusing on fixed forward contracts and using futures and options as tools as part of your marketing plan. Your future marketing plan should be largely focused on those fixed forward contracts. Futures and options can be used as an alternative tool or as your backup plan. Now, I don't want you using futures and options for 100% of your marketing plan. In 2011, MF Global, one of the largest commodity brokers, went bankrupt and left a sour taste and black eye in the industry. How do you protect yourself from that if you had a futures account with them? Well, the only thing you can do is if you're a large hedger, maybe you're using $500,000 in capital, you need to open up 5 separate accounts, put $100,000 in each account. It's more management on your part, but it could avoid you from maybe losing some money if this happens again. Studies show that futures and options work when prices are historically very high. So when are you going to use futures and options? When corn's at $8.49, when canola's at $7.50, when wheat's at $10, when soybeans are at $15, $16 a bushel. Futures should only be used by sophisticated farmers who understand the risk, can muster the margin calls, the daily volatility, and can sleep at night. If you're telling me you cannot sleep at night, knowing you have a futures position, there's potential for margin risk, then you shouldn't be in the futures game. Options are a less risky strategy when protecting unhedged bushels into the future. Only use a broker to execute a trade, not for advice. Keep your hedging account separate from your speculative account. If you intend to open one up, choose one person to pull the trigger or execute the plan, preferably one that has a passion for marketing. Both futures and options should still be a small part of the marketing plan unless you plan to use storage bins. Our sixth topic today is about knowing that political landscape. For example, over the past few years, we've known about this European debt crisis. In 2014, we've had this Ukraine crisis. You need to understand what that means to your bottom line. These are known as the outside markets, and they can impact your prices that you receive. Don't get caught with empty pockets. Everything in moderation is good. Arm yourself with the information, know-how, tools, and you will become a very successful marketer. Never panic, become less emotional, and do not chase a falling knife. Our seventh topic is about fundamental versus technical analysis. You have to be able to identify chart patterns when using technical analysis. Here's a chart, 2012 March Corn Daily Futures chart, and I've highlighted some of the patterns on this chart. Technically speaking, use the 5-day trading rule to identify a change in trend. In other words, when you call a bottom, you have to then confirm that bottom with a change in trend. Use 5-day trading rule. In other words, 5 higher closing highs, and you're good to go. When markets are crossing below the 50, 100, 200-day moving averages, this is a very bearish signal, and vice versa. Studies have shown that after a big advance or decline in prices typically will retrace 32, 50, 62% of the previous highs and lows. Remember, that's known as the Fibonacci retracement. Identify other chart patterns such as double and triple tops and bottoms and key reversals. Luck should not be part of your business plan. Try to ignore the noise, and it is never as good or as bad as the media thinks it is or says it is. I will end with Boone Pickens, the big US oil tycoon's famous saying, "A fool with a plan will always beat a genius with no plan." Don't forget to ask, what is your risk versus your reward? In summary, it's been a long journey, and it's been a pleasure of mine to help you, inspire you, educate, entertain you along the way. Risk is not knowing, but you now know. Don't forget to do some marketing. Manage your risk and volatility to maximize profitability and reduce risk.